can follow the latest reaction to HSBC earnings on our T-Live blog. That's T-Live Go on your terminal. Now, we heard there the HSBC CFO telling Manus that the bank is still investing heavily in Hong Kong and China, and that it remains confident in the long-term macro trends in the region. Now, Ewan Stevenson's comments come days after Beijing's crackdown on private business ignited a $1 trillion sell-off last week. But China is now seeking more communication with the U.S. on overseas IPOs. In a statement, the country's security regulator has called for talks with the SEC, and that's after the SEC required additional risk disclosures for Chinese companies last week. Now, Beijing has also asked for mutual respect and collaboration on the issue. Well, let's get into the issue. We're now joined with Christian Keller, head of economics research at Barclays. Christian, good morning to you. Thank you so much for joining us. So we heard there from the HSBC CFO saying that, okay, we're still interested in China. Of course, we always look at our risk books, but they're not seeming to make any big withdrawals from the region. Would you say that's pretty characteristic of how most foreigners are now approaching China after the past few weeks?
I think it is. Let's take a step back. There was a lot of regulatory intervention, and some people call it a crackdown. Various things the Chinese authorities did. But if you take a step back, this is the second largest economy in the world. It has decided to open its capital account to some extent already for fixed income, also for equity. It's a very difficult economy to ignore if you're a global investor. And I think, the whole strategic onboarding of China as an asset class, that will continue. But I think what investors got a taste of in the last few weeks is, it is not the same as investing in, a U.S. equity market. This is not a fully free capitalistic, economy, and the government can be much more heavy-handed intervening. And so I believe investors may reorient themselves, but it's difficult to think that they would really withdraw from something that looks to be the market of the coming decade, really.
Yeah, fair enough. I mean, it kind of reminds me of what our Bloomberg opinion Shuli Ren said, that if you're very invested or you're very aware of these Chinese markets, perhaps you're in China, you weren't necessarily surprised by what happened. Okay, so you need to reorient yourself, perhaps, if you're an investor. What parts of the Chinese economy or corporations, perhaps, become more successful from this, even if sort of the big mainstay tech ones face that regulatory crackdown? Are there other elements of the economy that see a benefit from this?
Yeah, that's I think the crucial question. The Chinese authorities typically are quite strategic about these things. And what was the message they wanted to send? And I think it was a twofold message. The one part of the message is they clearly want to have more control. And they want companies, IT companies including, to continue to raise capital, including in the US, through these various vehicles that exist. But at the same time, they want to control it. And second, and that what we believe was the more recent crackdown, in particular on the educational, on this tutoring sector, they don't want too many resources to go into that part of the IT. We think they want to channel resources, continue to be in IT, but more into what they believe are the classical made in China sectors they want to boost, and that is IT, but it's more maybe software, but it's also electric cars and those things where they want to gain manufacturing leadership.
Okay, so if that's some of the corporations, let's talk about the overall economic growth picture, Christian. We had PMIs a little bit softer. We had some noise from Chinese regulators or authorities rather, that the market seems to be interpreting as more accommodation to come. You had bond yields plummeting today in the 10-year space below 2.9%. Is that a fair interpretation that more support is on its way for the Chinese economy?
They started to indicate that with the first, RRR cut, the PBOC that is, that they would be willing to support credit growth and keep monetary conditions accommodative. If you listen to what came out of the Politburo meeting on Friday, even though there were not a lot of details, but in general, that was also a message whereby we could see some more fiscal support, be it through the issuance of bonds on the local side, but also we think in fiscal spending from the central government. All this is measured. I think the Chinese hold on to wanting to transfer the economy to a slow growth path, but there will be more support.
Christian.
I think they've realized that they slow too much.
Christian,